I couldn't make each work on its own, but I'm marrying the two, and there seems to be a really good business model here. The two asset classes combined are triple net lease retail combined with cannabis operators.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 268. I'm excited to be talking with a good friend and mentor of mine today about raising equity from investors. Vardya successfully exited a 26-year career in the information technology industry and began investing in real estate back in 2011. He started with single-family homes that he still owns and manages, and then began investing in commercial real estate such as Class B multifamily, hospitality, and office buildings. One of Al's many strengths is that he has created and maintains partnerships with sponsor groups syndicating private placement deals. Al has also built a family and friends network of investors providing capital for these syndications. He invests both as a limited partner and also co-sponsors some of these deals as a general partner. To date, Al has raised over $42 million in investor equity across 37 projects, 12 of which have been exited for upwards of an average annual return of 37% to his investors. Al, it's a pleasure to have you on the show.
Thank you, Brian. Pleasure to be here.
So I'd love to get a little bit about your background, who you are, fill our listeners in on how you got started investing in real estate.
Well, you did a great summary of the background. I'm a Midwest native, lived mainly in Michigan most of my life, and originally from India. As you said, I was in the IT industry for 26 years, started off as a programmer with Bell Labs, then more into the sales and business development roles later on in my career. I also had worked for and had ownership in a business right there in Grand Rapids, Open Systems Technologies, which was an amazing experience for me, for the leaders of the organization and for its employees. And I personally have sold my interest in that organization, although it's currently a thriving business today. We sold that in 2012, and that's kind of what was a catalyst to get me into the real estate side of things, because what happened is I was fortunate enough to be blessed with a lot of cash from the exit of that business. But because of that, I realized I lost my income stream. How do I generate an income without necessarily gambling on the stock market or taking that long-term outlook? And the answer kind of led me to real estate. So that was back in 2011, 2012 timeframe, where I started building a portfolio of single-family rental homes, which I to date still own in Phoenix and the Arizona area. And I soon realized that in order to scale that, I would need to go a different route. And that's what led me into the commercial real estate sector, primarily in the multifamily asset category is where I've focused. That's what led me also on the journey to work with and maintain relationships with sponsors that are experts in this arena in terms of underwriting, acquiring these assets, managing these assets, so that my role is more passive and focused more on the investor side and the equity side, as opposed to the operational aspects. So that's what started back then, about 8 years ago, and built momentum over the years, and yeah, that's my focus today.
I want to talk about how the real estate has kind of changed for you, because I know you started with the single families, like you mentioned, and you were doing some management of those as well. But what was the realization that, hey, wow, the single families are great. I need to kind of expand my network and partner with other operators who are doing this. What was that light bulb like that went off?
I think it was more of a progression. Two things I think that happened is I was trying to scale the single family business, and I was looking at different geographies outside of Arizona. I would have wanted to do it in Michigan. A local broker actually in the Detroit area said, Al, what you're trying to do, I would suggest you go this route. And he's the one who initially connected me with a group out of Raleigh that does nothing but acquire and manage and syndicate multifamily apartment deals. So it was a little bit of that connection. And then it was also a combination of realizing I think this would be a much better way to scale what I'm trying to do. And really what I was trying to do is to build a passive income stream. And what happened back then in 2012, I started that relationship with this Raleigh firm, started doing deals here and there slowly. I did a lot of due diligence, flew out there, looked at deals they were doing, looked at existing portfolios they were managing, met with their founders, the leadership of the company, try to just get a feel for their culture and, are they real? Had dinner with their families, all that good stuff, started slowly investing with them and slowly started to see success. And then what happened is friends and family said, hey, can I get involved in this next deal? Can I get involved in what you're doing? It slowly built into a friends and family network. It wasn't what I set out to do, but it's really what ended up happening is this network of investors grew to the tune of, I think we're at about 120 investors today. And my role has really become finding and maintaining relationships with the sponsors on behalf of my investors. And that's where I focus my time is on the due diligence with the sponsors and education to my investors. What happens then is when we define a set of sponsors we want to work with, when new deals arise from those sponsors, they look at me and my group as a major equity funding source for that deal. So an example, if we need $10 million equity on a deal, he'll come to me and say, Al, I can give you $5 million equity, go raise it. So he's not worried about basically each investor raising that 5 million, but he comes to me, says, hey, here's the number, go meet it. And then I work with my group to come up with that equity.
It all sounds like it happened somewhat organically, where the friends and family just said, hey, Al, what are you doing? Can we come with you? But there's a lot in what you just said that people spend a lot of money, a lot of time, a lot of effort into creating. And I know you make it sound effortless, and knowing you, I know that it is somewhat effortless to you. But yet there's a lot of artistry and technique to what you're doing. And so I'd like to break that down, and starting with just your relationship with the sponsors. I mean, you talked about going to Raleigh, really getting to know the sponsor, having dinner with his family. What are you looking for in a sponsor that you're going to develop a relationship with and have that kind of relationship where they can call you and say, hey, Al, I need $5 million for this deal. Are you in? How do you vet that sponsor?
There's several factors that I look at, and I'll kind of lay them out, but tell you which ones we prioritize over the others. We definitely look at the asset class. What is this group investing in? What's the sponsor investing in? There's a myriad of asset classes when we talk about CRE and commercial real estate, apartment buildings, hospitality, commercial office space, industrial, storage, mobile parks. I mean, the list goes on and on and on. So what do we want to focus on as an asset class? And it's been 70 to 80% multifamily apartments, Class B. That's been the space. So I look for sponsors that are experienced in that space. And then we also look for geography. So we're looking for high growth. We're not limited to any specific geography. So we're looking for across the US, where are the regions that are growing, that are not overvalued, that we see a very nice demographics and economic growth trend. That's historically been in the last 8 years for us. It's been the Sun Belt states. So this goes from Carolinas down through Florida into Texas. That's where most of our geography has been focused. So we look for sponsors that focus in those areas. So that's kind of maybe just a prerequisite, but I think the real key things are track record and execution. So I look for people that don't just talk the talk, but they can back it up, right? So I want to see deals that they've done in the past, deals they've exited, what they've done for their investors, track record. So that's very important. I want to see style. So style is, and now we're getting into a couple of soft factors, but these are probably the most important. What is a style? There's a lot of fast talking salespeople and people that are beating their chest on what they can do and what they might have done and so forth. But we tend to align better with a very conservative, non-sales approach. So just someone who's very conservative, very realistic, very genuine. And again, these are not, how do you measure that? It's just an eyeball test. So we're looking for and by the way, the underwriting on these deals, you can make any deal look like the best thing since sliced bread or very a bad deal, right? So I tell my investors, don't get caught up in looking at the spreadsheet, because this group, the sponsor I've worked with on many, many deals, they forecasted X percentage. They've delivered X plus Y percentage always. So he's going to underwrite, project conservatively versus someone who's projecting much better than X, but they deliver less than X. So it's not so much the underwriting, it's more the assumptions and the style of that sponsor aligning to this group, to me, to our group. We've got most of the people in our group are extremely conservative and passive investors. They're physicians, business owners, IT guys. So they've got a good income. They're accredited investors. They've got a good net worth, but they're relying on me somewhat to do the due diligence, but they want to align to conservative nature, sponsors. And I think the other thing I've learned over time is a sizing. So we tend to work with smaller sponsors. And the reason I say that is because in our experience, and we can talk through some examples, but we've seen some negative experiences with groups that are larger in size. And I don't know if it's just a coincidence, but I think it's because they've got a staff to maintain and they're not as agile when it comes to recognizing and moving on trends and opportunities. So what I've seen is much better execution track record relationships with groups that are small in size. And we tend to favor those and maybe some large corporate type of, sponsor group.
You just gave so much great information there in your answer. I'm wondering, you must be approached by a lot of different sponsors who would like to work with you and have your help in raising the equity. What are some of the other things that separates the sponsors that you do work with versus the ones where you're like, I like it, but I'm not so sure I want to work. I want to work with this particular sponsor. What are some of those factors?
I do get approached by a lot of groups because there's deals, tons of deals out there, right? There's no shortage of deals. Probably 98% of them I'm going to say no to. A lot of it is just the factors that I went over, but it's about comfort level. It's not about the deal. So I've changed my workflow and process to not be deal driven, but to be people driven. So I'm going to look for, based on the criteria I laid out, the people I want to work with, and then evaluate the deal. So it's kind of like a backwards way it might seem like, but this way I'm not shooting, from the hip, and I'm not chasing deals. I'm chasing the philosophy and the culture and the mindset and the style and the execution track record of a group of people. And then let's talk about the deals that they have.
In putting these deals together, what are the sponsors offering you and your investors as far as the equity share, return on investment? Is it the same over each deal, or does it differ on each depending on risk and other factors?
Yeah, every deal is standalone, so it differs in every deal. There's two general buckets of deals. One would be a fund, and one would be a deal by deal. Each deal is its own legal entity. So we tend to favor the deal by deal approach because it's more transparent, it's more measurable, because you've got an exact project, a property, you can assess it and analyze it, versus a fund where now I'm going to tell you there's a couple of funds we have invested in, one which has been a very good experience and one which is not. To answer your question about what an investor could expect, let's talk about the individual deal level. Typically what happens is there's a limited partner equity stack and then a general partner equity stack. So the GP are the sponsors that syndicate the deal. And typically they're getting some percentage of equity for syndicating the deal, for finding the deal, for doing the legwork, for taking the liability, for signing on the loan, for putting up hard money before the close. So they're doing a lot of stuff. And because of that, they typically get an equity percentage, sweat equity, let's call it. And it varies, and there's a lot of tiers involved, sometimes based on performance. But to simplify it, it's typically around a 30% mark. So a GP gets 30% of the equity, and then the limited partner or investor, their investment will buy into that 70% limited partner bucket. And typically what happens is the investors will get a cash flow or a preferred dividend before the GP even takes a penny. And only after the investor is returned their preferred dividend will that equity split kick in on additional cash flow or during a sale or refinance. Then the underwriting or the marketing package lays out what investor numbers or returns are projected to look like on a cash flow basis as well as on a capital event basis.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. And what do you typically see then as far as the projections of what those returns will be?
Right. So the projections have tapered down a bit over the years as the asset classes have risen in value. What we used to see, let's say 5 years ago, is a 7 to 9 to 10% dividend this is regular cash flow on a monthly or quarterly basis an investor would receive. And then a projected total return on investment of 15 to 20% annualized over the life of the project, which is projected to typically be 5 to 7 year hold period. Those numbers have come down a little bit. So today we might be looking at 5 to 6, maybe 7% cash on cash return on a cash flow basis, and then 10 to 15% annualized over the return or over the life of the project, again with a 5 to 7 year hold. So those are the projections you mentioned, Brian, in the intro. The actual exited deals that we've been involved in have done significantly better. Again, this is a reflection of under promise, over deliver is what's happened. So the ones that were projected at 15 to 20%, a lot of these we exited in 2018 at these high 30 levels in terms of return on investment for the project, annualized 37% return. So there's projections and then there's actuals. Not to say they're all going to be that good. This is a business, and any business, there's good deals and bad deals.
Yeah, absolutely. And I want to make sure our listeners understand what you're saying there. That on 12 of the deals that you've exited, your returns to your investors have been 37% or better per each year that they were invested in the deal. So it's not like they exit after 7 years and they have a 37% return. No, it's a 37% return each year averaged out. That was if you average it out over the years that they were involved.
Absolutely. It's annualized, correct. And it reflects your dividends and cash flow during the holding period, and it reflects the capital gain after selling the property, and it reflects potential return of capital during the hold on a refinance. But correct, it's an analyzed number.
The amount of time that someone is invested in one of these deals, you said 5 to 7 years. I've encountered both types of investors who want to be out in 3 years and investors who are fine to stay in 10 years or longer. What do you find with your investors? What is their preference?
Well, I always tell my investors, if you can't tolerate a 7 to 10 year window of hold, of illiquidity on this money, don't invest. Having said that, our actual hold time has been under 3 years. So of the exited deals, the average hold time has been under 3 years. And that's just a reflection of the market. It's a reflection of transactions are moving faster, moving quicker. Valuations are reaching to the projected levels quicker. That's a good thing, but it's not something that people should get accustomed to or expect moving forward. So I'm setting the expectation it should be a long-term hold, right? It's 7-10 years. It's not money that's giving you zero return in the meantime. It's still providing you a cash flow, and it's providing you a regular dividend over the time.
We talked about your great successes with the 12 that you exited at 37% average annual return. I'm sure there have been one or two that have not performed the way that you would have hoped. Can you talk about those at all?
Sure. So in this business, as much due diligence as one does, there's always going to be surprises. In the spirit of the good, the bad, and the ugly. So the good, we've talked about the good. The bad would be a portfolio of deals we've got with one sponsor that we initiated in 2018. Well, put it this way: the properties are performing well in terms of, these are all multifamily apartment deals, by the way. The occupancy numbers, the leasing numbers are all very good, but it's not translating to investor distributions because cash flow management has not been stellar. There's 6 properties we have with this one group. Of those 6, they've suspended distributions on 4 of them and have reduced distributions on the other 2. So the projections we think were overblown, overinflated, and I don't think the execution was where we wanted it to be. So that's an example of a deal where it's not exited. we still have a strong hope for getting double-digit returns over time. Operationally, they're doing well, right? It's a matter of managing the cash as we go along and exiting the deal, hopefully in the short term here. That's in the bad category. The ugly category is outright fraud. So this was one of the funds that we had invested in Manhattan, actually in New York City. And it was supposed to be a zero leverage, zero debt fund to go buy luxury condos in Manhattan and have corporate tenants. And the due diligence I did was similar in the sense I flew out there, met with the staff, the leadership, looked at their properties, looked at their locations where they're doing business. They had an 18-year track record. They were on their fourth generation of fund. And it's seeming to be, we're getting all the facts in now, but it seems to be that the prior generations were fraudulent as well. They had misrepresented the performance numbers. Today, our fund is in liquidation. The SEC, FBI are investigating the CEO that we think was siphoning money off the top, and so it's a mess. It's a mess situation, and we might just get pennies on the dollar after all this is said and done. So they've hired a receiver to freeze the assets, sell the assets, and maximize investor return. But it's going to be pennies on a dollar situation.
Oh, that's definitely very painful. I mean, was looking back on it, were there any red flags that maybe you overlooked? Or if they're lying to you, they're just lying to you, and they can. A lot of this business is built on trust.
A lot of it is built on trust. Now with the fund, actually, what's interesting is the fund has more legal, or let's say regulatory compliance constraints, meaning, as you probably know, it's very regulated by the SEC. The SEC apparently was regulating this organization for 18 years with their fund structure, along with my due diligence. I've got a core group of investors that also help me with due diligence. So nobody found any red flags. We were totally, this one stumped us, and we were shocked at what ended up happening.
Wow. Well, thanks for sharing the good, the bad, and the ugly there. Let's move over to the other side, working with investors, because you've managed to bring in, I think you said 120 friends, family, acquaintances into your investor group. How do you communicate with them, work with them, and get them on board when you go after these different types of opportunities?
A lot of it is because this is what I love to do. I love to be involved with my group of friends and family in doing these kind of ventures. I spend a lot of time in educating people. So if we have somebody in our group that introduces me to some new potential investor, I'll spend a lot of time with them talking about what we've done, what we do, what they want to do, kind of the whole business model, what I've got in the pipeline, and education. So that's number one. And number two, I spend a lot of time with investor communication, just making sure investors are aware of what I'm doing with my sponsors, aware of the pipeline, and when we have a need for funding at what time over the next several months. So a lot of it is just time spent on education, on transparency, and communication. I think at the end of the day, it's trust again. So these are not people I'm typically marketing to. It's just people that have been referred to me, and there's a trust level that provides them with some comfort level because most of these folks are not active investors. They're active in what they do. And so they're relying on me to some level to do that due diligence and to maintain that relationship with the sponsors. I also get involved in a lot of the grunt work too, in terms of paperwork and facilitating the coordination of all the execution of paperwork that needs to get done between investors and sponsors.
And these investors that you're working with, are they accredited, sophisticated? I mean, what are the requirements to be an investor in your group?
Yeah, these deals that I get involved in, the private placement deals that are syndicated, have a requirement for the investors to be accredited. And what that means is they have to meet a certain net worth requirement as deemed by the SEC or a certain income requirement over the last 3 years. And so these are typically high net worth individuals.
So, Al, I'd like to learn a little bit more about just the types of asset classes that you've been investing in and where you see the trends heading now, especially with coronavirus and that their effects. What are the asset classes that you've liked, and what do you like going forward?
This is an interesting question. The asset class that we've loved and we continue to love is Class B multifamily apartments. So these are typically 200, 300 unit apartment complexes that are workforce housing, we call it. Stable, steady, has withstood 2008-9, has withstood coronavirus. The challenge there is its valuations are getting very high. The other asset class that we are in, which has taken a beating, to be honest, is hospitality. So hotels, especially a full service hotel, which relies on corporate bookings and large gatherings such as weddings. Those are, of course, not faring well since March of 2020. I still think, and there might be some deals to be had there in that space now, but I still think it's a long runway of when that stabilizes, could be 2 years, 3 years, 5 years. So we're staying away from that asset class. We were in some office buildings, office space. Luckily, we got out of that prior to March of 2020. So right now we have zero exposure to office space and don't plan to in the future. So what are we looking at now moving forward is really two things that I'm looking at, my group and I. One is multifamily. However, as I said, the valuations in especially major tier one cities are getting through the roof. Cities like Atlanta, Raleigh, Charlotte, Tampa, the numbers just aren't working out. The deals aren't there. We did do a few deals in Tampa just recently, but that was post-COVID, where we saw a slight dip when sellers didn't know which way the economy was going to go, and there was a slight opportunity we took advantage of. But moving forward, what we're looking at now for multifamily are geographies that have better economic structure and better demographic trends and better growth trends. And the one area is the Pacific Northwest. Actually, the one state is Montana that we're focusing on. So this is specifically with one of my sponsors. We've done deals in Montana very successfully with this sponsor. And he has several deals in the pipeline for new development. So we're looking at buying land, developing apartment buildings, multifamily, same type of characteristics in terms of sizing and profiles for renters. But a couple of things in Montana is, and especially after March, the push has been for wider open spaces. Montana as a state is seeing tremendous growth. The supply for multifamily is surprisingly, shockingly, very, very low. There, on a trip I did out there to look at all this, I was just amazed at there just isn't any inventory. There's very, very old, not so nice complexes, and that's it. And rental prices are extremely high in that part of the world or part of that country. So we're going to take advantage of the trends and work with this sponsor who has delivered us tremendous success in the past, and then ride this wave with the sponsor for new development multifamily deals in Montana. The other asset class, and it's actually two asset classes that I've been investigating for the last year. I couldn't make each work on its own, but I'm marrying the two, and there seems to be a really good business model here. The two asset classes combined are triple net lease retail combined with cannabis operators. What I'm talking about here is triple net lease. If your listeners are aware, is where the tenant pays for most of the expenses. Typically, you see this in a CVS or a McDonald's or a Taco Bell or a Dollar General store. These companies don't own that real estate. Private investors do. And these companies are tenants that are doing a triple net lease deal. So I was looking at these kind of deals. There just wasn't enough return in it. But now what I'm doing is the triple net lease deal structure where the tenant is a cannabis retail dispensary. And we have a short-term window here where what I've done is I've partnered up with a very successful cannabis operator. They're vertically integrated, meaning they grow, they cultivate, they wholesale, and they have retail. And they're across multiple states, highly profitable, highly successful since 2016. They want to grow their footprint of retail dispensaries. One of the states today they're focused on is Michigan. They want to grow that footprint. They don't want to necessarily invest their cash in real estate to do this. Just like CVS doesn't want to invest their cash in real estate. They're looking for real estate partners. I'm going to be that real estate partner for this one organization. And we're going to buy the land, the building. It's going to have the proper cannabis licenses issued by the city attached to that real estate. And then we'll turn around and lease back to that operator, triple net lease, meaning we'll have a very predictable, identified, steady cash flow from this operator. And we'll have an opportunity where today this operator can't go to a bank and get a loan because it's federally not regulated for lending. So there's a short-term window for private lenders like us to step in and to have higher lease rate where the economics are very rich on this type of model.
Wow, that's really exciting. Both of those asset classes and directions that you're heading are kind of unique. I mean, I've not talked to anyone who's invested in Montana, but it makes perfect sense. And then the cannabis industry, I mean, I'd love to have a follow-up conversation a year from now to see how that's going. But it is interesting that with both of those, it seems that you did not just wake up and say, hey, I want to invest in cannabis. No, you found a partner or knew somebody who was already in that space, and you saw the opportunity to work with them.
Exactly. In fact, the group that I'm talking about are old, longtime family friends. So very good friends of ours. It's their sons that have founded this business. There's a high level of trust that we already have, even before setting out on this venture, and very well-renowned and successful in this industry. Also, what's interesting with this time of year with the elections is regardless of what your political belief is, with Biden and Harris set to come in, there's a couple of acts in Congress today. A SAFE Banking Act that's going to legalize federal lending on cannabis businesses. And there's also what's called a MORE Act, which is attempting to legalize and regulate the entire cannabis industry. In fact, the MORE Act was led by Kamala Harris in the Senate. It is led by her. It actually passed Congress, the House, last November, and is waiting for Senate approval. The other act is also waiting for approval. So that's why we think within the next year, 2 years, 3 years, the valuations are going to skyrocket on these types of properties. When, as an operator or as a potential buyer, I can go in and get a 4% low interest long-term loan from my local bank or a Wells Fargo or a Bank of America. So we think the cap rates are going to compress. Our entry cap rates are at 12% today. Our cash on cash returns are 8 to 9% as an investor. Our projected very conservative returns are 20% project over the project returns, 20% annualized with a 3 to 5 year hold period. However, based on the exit, it could be substantially higher to the investor. So I'm excited about this space. I'm excited because it's a growing industry. The trends are there. There's too much tax dollars. 5 states just legalized marijuana in this last election, and that's growing. That number of legalized states is growing. The federal at the federal level, we've got a lot of momentum. We've got numbers that work today with the business that is doing extremely well. We're going into this on the real estate side. So even though our tenant is the cannabis operator, we are not directly involved in that business. So our focus and our angle is still on the real estate side. Some people can hear the word cannabis and think it's risky, but in a way, I think it's the opposite. One way to mitigate risk is to reduce your leverage. And how we're doing these deals are with zero leverage. There's zero bank loan. And that's why I feel the risk level is very low. And to see 20% project returns and 8 to 9% cash flow on an ongoing basis without leverage is, I think, very attractive today.
Yeah, that's very exciting. I mean, you're getting in just before it seems like just before it explodes, because once it's legalized on the federal level, especially the lending portion of it, yeah, you're right. You're going to see a lot more investment in that area. So that is an exciting opportunity. Al, as we wrap it up, why don't you tell our listeners how they can get a hold of you and who should get a hold of you?
Well, number one, as I said, most of these opportunities are for accredited investors. The best way to get a hold of me to get on a distribution list would be to call me or to email me, and I can give you that. My phone number is 248-444-7670, 248-444-7670. My email address is oldivyrealestate@gmail.com. Old Ivy, OLDIVY, real estate, all one word, at gmail.com. And that's the branding of my group. My organization is Old Ivy Real Estate Partners.
Any advice or thoughts as we wrap it up, whether it be for sponsors who are looking to raise money or passive investors who are looking to deploy money?
For investors, my advice is to tread carefully, be careful who you work with. There's a lot of crowdfunding out there today where you can just get on a website and invest $10,000 or more. Very easy to invest, but I would say to do your due diligence, make sure you know who the sponsor is, who you're working with, and do that level of due diligence. For the sponsors, I don't really necessarily have advice, but I'm just going to say who we work with are sponsors that are very real in their assumptions, take a very conservative stance in their approach and in their underwriting. And those are the types of people that we like to work with, as opposed to people that just need to do volume and are, sometimes making assumptions that don't jive with reality. So we're very selective now in who we work with as a sponsor, and then also as an investor, because actually, and this has been true from day one, we have more investors that have money on the sidelines than we have deals to put it to work. It's not the case that we're out there beating the drums looking for investors. We are. I want to make sure that it's a good fit for the investor. I want to make money for investors and have them enjoy this, but I want to make sure it's the right fit.
Al, this has been a great conversation. I always enjoy talking with you. And thanks so much for just sharing your experiences, being a passive investor, working with sponsors, and then working with investors, friends and family who you're bringing into certain syndications and funds, and then also just sharing your outlook on the different asset classes and what you're focusing on in the future. It's been a great conversation. Thank you so much.
Thanks, Brian. Always enjoyed talking with you. Thanks for having me on the show.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.